Good morning, everyone. Welcome to Windsor Brokers live daily markets outlook for Friday, 15th of February 2013. I do apologize for small delay in starting the the session as I faced some technical issues here, and they took some time to be solved. Anyway, we are at the last day of the week with the, of course, top event today being the G20 meeting in Moscow, and it might not be just hand-to-hand combat, but currency war that came to Moscow today as finance officials from G20 group of 20 nations paired over Japan's expansive policies that have driven down the value of the Japanese yen. Recently, it dipped as low as 94.45. This is the lowest seen so far against the US dollar. The G20 forum, which put together a huge financial backstop to halt the market meltdown in 2009, is now back in the spotlight after a week in which the group of 7 rich nations tried and spectacularly, of course, failed to speak on currencies with one voice. Recall of a few sessions ago when he mentioned when they came with the quite confusing communique after the meeting and basically triggered more confusion in the markets. The G7 has long been the powerhouse of financial diplomacy, but tensions between Washington and Tokyo have risen over the new Prime Minister Shinzo Abe's bid to end 2 decades of deflation, as the G7 issued a joint statement reaffirming a long-standing commitment to market-determined exchange rates, as they said. Yet the show of unity was quickly undermined by off-the-record briefings that criticized Japan. Hosts Russia said the G20, which includes leading emerging markets and accounts from 90% of the world economy, will back the trust of the G7 text when they issue their communique tomorrow on Saturday. And the Russian's Deputy Finance Minister Sergei Storchak said the drafting discussions was proving difficult, but the final text would not single out Japan for criticism. As an immediate result, the yen significantly appreciated against the dollar and dipped to the key support in the near term at the 92 zone. Yet we need to see action below these levels in order to confirm that some recovery of the Japanese currency is underway, and the weekly close below 92 basically from the technical point of view is seen as a good signal for some stronger recovery of very weak Japanese currency. From the other side, the euro remains under pressure following yesterday's break below 134 handle and the extension down to 133.13. We are approaching basically the 133 Fibonacci and the psychological support, and the more significant is break point. This is the break point zone actually at 133 and the 132.65. That is coming now under pressure. Sterling is in a brief corrective action, but overall bears are still keeping the downside firmly in focus. The fresh low reached yesterday's 154.74. Now focus is shifting towards key supports and the larger pictures range bottoms at 152.67 and 152.33. These levels are also a floor of the larger broader range of the British pound against the US dollar. As mentioned, dollar yen is sliding lower. 92 is under pressure. We will see later on in the technicals more details, while dollar Swiss gained some ground following break and close yesterday above 9200. That was basically capping the recent congestion in past couple of sessions, not allowing the pair to expand higher on its recovery attempt from 90.20 recent low. Now break above this, and yesterday's close briefly above this level sees potential for some stronger corrective action. Of course, we need to see the break of yesterday's highs. That also marks 61.8% retracement and regain of minimum 93.00 in order to confirmed with the 9200, of course, previous resistance now acting as support, expected to contain the downside. Brief look at the commodities. Gold came under increased pressure again following the fears of a further deepening of the crisis and recession in the Eurozone. A fresh low posted yesterday at 1630. I mentioned in yesterday's comments for the yellow metal, I forecasted 1622, which is Fibonacci expansion level. Of course, we have the interim supports. The first one has been taken out already. It's 1635 previous low, and 1625 now comes under increased pressure, and then we have 1622. So basically, we are close to our near-term targets, but overall outlook is still quite negative for the gold at the near term, while crude oil remains well supported for now after bouncing, after attacking the upper boundaries of recent range at 98, zone 98.09 seen so far, with downside so far being protected by 96.60 zone. We are going to elaborate this more in our technical part. Let's just take a quick look at today's calendar before we move to the technicals. Significant releases are seen. Retail sales from UK due at 9:30 GMT. According to the forecast, that is quite optimistic, 0.5% in January. It could be great improvement from a contraction of -0.1 in the month of December. Eurozone trade balance is due at 10 o'clock. GMT shows a slight narrowing of the trade surplus from 11 billion in November to 10.7 billion euros in December. And then data from states that are more significant. Empire State Manufacturing Index for February 2.1 improvement compared to -7.8 in January. Industrial production from United States at 14.15 GMT, 0.2%, a slight decrease from December's 0.3%. Capacity utilization rate for January at the same time is expected slightly to improve according to the forecast, 78.9% versus 78.8%. And then University of Michigan consumer sentiment for February forecast is quite optimistic, 74.8 compared to 71.3 in January. And basically these are the highlights. I would say more focus is still seen on the US session, except the retail sales from UK that are seen as a red alert from the economic indicators. More focus again seen in the closing close to the end of the day in the US session, when most of the economic indicators will be released. And now we come to technicals. I do apologize for speaking a bit faster. We are a bit short with the time. As I said at the beginning, we had some technical issues in starting the session. So we're going to take a look now at the technicals for all majors and the commodities. Starting with euro, that is accelerating lower again at the beginning of European session. A brief corrective action of yesterday's fresh low at 133.13 was capped by descending 55 days, hourly 55 days exponential moving average, and from Fibonacci levels, a brief look, exactly 38.2% of the down leg from 135.18 down to 133.13, keeping the downside pressure intensifying. Again, I would say downside pressure, although overall short near-term structure is still negative and still sees pardon, focus downside in focus as part of corrective reversal from 137.10 peak of 1st of February 2012 that so far retraced exactly 38.2% of the uplift from 126.60 to 137.10. Good support at 133, that is 38.2%, and then more significant levels are coming at 133.60, 133.70, where we have 133 is also the previous peak of 19th of February, pardon, 19th of December, while 132.70, where it is 75 at this moment, is the bull trend line of 126.99. Pardon, it will correct 126.60. I do apologize. And January's range floor at 126.65. These are seen as a break point. 133, 32.65 for fresh extension lower, where we have another set of strong supports. Trend line, this is the main bull trend line drawn of low of July 2012 at 120.42 and currently standing at approximately 131.85. That also marks 50% retracement of the entire 126.60, 137.10 ascent. And also we have the previous peak of 9th of September 2012 at 131.70. Pardon, that offers another very strong support and another break point for some more significant reversal of the larger 120.42, 137.10. Now again, from the fundamentals, a lot depends on the today's G20's tomorrow's G20's release that will again give put some more lights in the current situation of the euro. Of course, a negative tone continues to dominate on the lower time frames that sees scope for further extension of the down move from 137.10 at this point, with initial resistance seen at 133.92. This is the highest seen today. This is session's high, and then we have 134, 134.65, 38.2%. I would say anything below previous low at 135.18. So basically holding below 135 would keep the bears in play. Otherwise, only break above 135, 135.18 is to sideline the bears and they open way for some stronger recovery. That is quite likely according to the current structure of the euro dollar in the near term. A larger picture also is maintaining a negative tone. As we can see, the all indicators are in the descending mode, and they're seeing a threat, serious threat for a break below 133, 132.65. Of course, end of a week is going to give us some more action acceleration, and basically some profit taking cannot be also ruled out at this point as we go closer towards the end of the day. But overall, bears are still now firmly in play, and the immediate focus is at 133.00, our next downside target, ahead of 132.70.65 levels that I already mentioned. And the British pound, brief corrective action seen, minor of fresh low posted the late hours of yesterday at 154.74. I think we can see it better on the daily, where we have a steep decline that was signaled basically by loss of initially the range floor at 158.26, and then break below the main bull trend line, longer term bull trend line of 2009 low. This is quite a bearish signal, and this is a potential for further extension lower, as the pair lost yesterday 155 handle. Now we are looking for a test of 154 zone, 154.74 seen so far. This is approximately just ahead of July 2012 low at 154.57, and then we have 154 zone psychological support, and 153.92 is the low of 8th of July 2012. These are the immediate targets, and the more significant ones are the floor of the larger longer term range. We have several points here from 2010 through 2011 and 2012 lows. Basically, we're talking about zone between 153 and 152.30, and this is coming in the near term focus in the British pound US dollar set price action, as strong bears accelerated following a double top pattern seen now on the weekly chart, highs of September and December 2012, break below the range floor at 158.26, accelerated losses, and we are looking now for further extension lower. From technical point of view, it's very bearish. Some brief corrections might be seen, but nothing significant as long as we are holding below the 200 days moving average. This is also approximately close to 50% of entire down move from 163.80 to 154.74. It's currently at 158.80 65 along with the two previous peaks at 158.43 and the 158.77. Set a break above 159, let's say, will be providing relief. Otherwise, strong bears are still looking for extension down towards our targets at 152, 153, 152, 50 zone. Some just a brief look at the hourly. Initial resistance is 156 approximately. Then we have 156.30. The previous, pardon, 155. I do apologize. Where we are now, 155.28. So we have 155.71. Then 156, 156.30. Anything above 150. 7 would provide the near-term relief, but as said, minimum requirement is seen on a break above 158.43. That for now looks quite unlikely, despite the 4-hour indicators are oversold and now emerging out of the oversold territory. Any move higher could be still seen as corrective action. Dollar yen said it's now approaching critical point at 92.00 following pullback from 94.40, 45 attempt to build the double top here, following failure below 93.00 as initial support. Now fresh weakness accelerated, of course, by comments from G20 now being quite supportive for Japanese yen, seeing immediate risk at 92.00. We have the previous lows 92.17 and then 91.97 along with 38.2% Fibonacci retracement of rally from 88.05 to 94.45, and we should be watching this level as a trigger, as a break point, a sustained break here, and a possible close, weekly close below 92 would be a good initial signal for some more significant corrective action. Holding above 92, of course, will still keep the pair within the 92, 94, 45 range, but quite likely scenario is seen on the break because 4-hour indicators are quite negative at this point, and see potential for fresh extension while price holds below both 55 and the 20 days exponential moving averages on the 4-hour chart. And also the daily structure shows overextended conditions and the indicators already emerging out of the overbought territory. That is one of the initial signals. Of course, a lot of work towards the downside needs to be seen in order to confirm some stronger recovery of Japanese yen. Break below initial 92.00 seen as a trigger, and then we have previous highs 91.24 and 91.00 that will confirm the near-term bearish stance. But of course, break below 92 seen as initial signal. And dollar Swiss, as we said again, some ground, though not strong. Basically, on the 4-hour chart, the bulls are now showing some improvement. Break above recent congestion 91.50, 92.00, and close above these levels seen yesterday is now shifting again focus towards the upside as a part of the near-term recovery from 90.20 low of 1st of February 2012. Just to show that larger bears are still firmly in play, and we need to see break above minimum 93.80, 94.00 in order to confirm the base and the sideline the bears. However, the near-term studies are now in the positive territory. 93.47 has nearly been tested on a stretch to 93.44. This is 61.8% retracement of the down leg from 93.87 to 90.20. We are in the 4-hour chart with the all indicators above the midlines and the price being underpinned by 91, 95, 200 day, 20 days exponential moving average that comes along with the previous resistance now support 92.00 zone that so far contained dips. Of course, break above 91, 92.47 is seen as initial trigger for stronger recovery. We need to see again break above 93 psychological barrier and 76.4% retracement to confirm the recovery attempt. Any slide below 92 would be initial signal of weakness, while loss of 91.50 will be bearish again and would be signaling a possible lower top and fresh extension lower. And the more interesting is gold at this point, as it remains under heavy pressure, and we are just witnessing a fresh weakness at the beginning of European session, cracking briefly the yesterday overnight's low at 16.30, now 16.29. Overall tone is quite negative, though extended hourly studies might see some corrective consolidative action preceding fresh weakness. A similar situation is seen on the 4-hour chart, where we are in the oversold territory, but still all indicators are pointing lower. There is no yet reversal signal seen clearly from the indicators. Focusing our targets, our target 16.25 is the low of 4th of January 2013, and then we have, I just need to find it, okay, it's here, the 138.2% Fibonacci expansion of the down leg from third wave. We are talking about third wave from 1684 peak of 5th of February, and this is seen as our next downside target, along with the 1625 and another Fibonacci level 61.8% expansion at 1612 ahead of psychological 1600. According to the current structure of gold's technicals, it's quite a high risk of further extension down towards 1600, as the larger picture indicators are firmly bearish. Break below 1625 static support is required to confirm the bearish stance and the open way for further extension lower, as a part of a larger down move from 1752. This is the high of the lower top of pardon, November 2012, and the yearly peak at 1795 posted in September 2012. That so far traced and is testing basically 61.8% of the larger recovery rally from a critical support at 1526 to 1795. Now cracking this level could be a good signal for some further weaknesses. Overall picture is still firmly bearish, and the yellow metal is channeling lower. Our target 1625, 1622, then 1612, 1600 seen on a break. On the upside, initial resistance 1639 previous lows, and then this is reinforced by descending 20 days exponential moving average of the 4-hour chart. Lower top at 1650 along with the previous resistance, basically seen capping for now only break above, clear break above 1653. Higher lower top of 13th of February would provide near-term relief. Otherwise, focus remains at the downside targets. And a brief look at the crude oil that remains so far well supported. Yesterday we mentioned that 96.60 recent lows posted on 12th and 13th of February, that also mark 50% of the rally. I do apologize, we are in the wrong Fibonacci direction. Approximately 50% again, we are there, of the recovery from 95.00 to 98.09 so far, seen the highest seen as a break point. For now, the downside is being protected by ascending 55 days moving average, keeping it guarding the further guarding the downside for now, but a break below 96.60.50 could be seen as increased risk for possible further extension. Will be just signaling that the oil price remains within the range. For now, for our indicators are descending at this point, and focusing again. 97 is being tested already, 96.60.50. In case of break here, we can expect it to lower down towards 96.16, 61.8% retracement, and 96.00 round figure resistance. On the upside, break above recent peaks at 97.70 approximately is required to shift the focus again up towards 98.00, 98.09, 22, and 98.54 Fibonacci expansion barrier. On the hourly, more neutral tone, still seen at this point. We are within the 96.60 and the 97.70 range, but slightly skewed towards the downside as the price loses initial bullish momentum. Again, might be seeing a risk of retesting 96.60. Basically, we have to keep focus on the downside at 96.60.50 levels as a break point towards the downside, and on the upside 97.70 to shift focus higher. Overall picture is still positive, and the latest movements could be described as consolidative rather than corrective, as long as strong support and higher base at 95 area holds the downside. And basically that's all from me for today, Friday, 15th of February 2012. I do apologize. Do we have any questions? We have to be quick because due to the delay, we are going to affect the coming session that comes in approximately 4 or 5 minutes, and is in Arabic language. It seems no questions. Okay, if not, then I will thank you all for attending our live session, and wish you, of course, nice and profitable trading on last day of the week, and of course nice and relaxing weekend to be ready for the Monday's fresh session and the Monday's business. We are starting at the same time on Monday at 8:00 GMT. The session also, for all those that came later and missed any part, you can find it recorded and loaded in the YouTube. Our page is called Windsor Brokers Forex. Until Monday, I wish you a nice Friday and a nice and relaxing weekend.